Okay, let's dive right into this. Listen, if you want to know the absolute ground truth about the health of the global capital markets, you don't look at the talking heads on financial TV. You just don't. You look at the toll collectors. You look at the companies that own the underlying physical infrastructure of finance itself. And right now, there is literally no bigger, more structurally critical toll collector out there than S&P Global. So, welcome to this Iron Financial Explainer. Hit subscribe so we can help you cut through the market noise and forge a stronger portfolio. Today, we are conducting a rigorous structural stress test on S&P Global's Q2 2026 earnings. Now, as of July 1st, 2026, they completely spun off their mobility unit. That's a massive move, transforming this company into a highly streamlined, four-pillar financial intelligence powerhouse. And we're going to tear into the numbers to see exactly how strong this new foundation really is.
All right, here is the inspection blueprint for today's structural stress test. First up, we'll examine the post-spin foundation. Second, we're going to stress test the core pillars. Third, we'll look at the heavy lifting, meaning capital and cash. Fourth, we'll analyze the blueprint for 2026 guidance. And finally, we'll render our verdict, ironclad or trap. Let's go.
Section 1, the post-spin foundation. Let's see what this company actually looks like now.
So, when a mega-cap company like S&P Global amputates a massive division like mobility, the financial statements instantly become this chaotic construction site, right? There's dust everywhere. Our job today is to strip away all that dead weight, clear the debris, and look exclusively at the true load-bearing beams of the surviving business.
Yeah, well, hold on a second. Before we start praising this brand new foundation, I really have to ask the question that pretty much every retail investor is screaming at their screens right now. Is this post-spin performance actual, real, organic growth? Or is it just masterful accounting engineering? Because you and I both know management teams absolutely love spin-offs for one reason. It lets them shuffle the deck and hide their flaws. We are staring down the barrel of higher for longer interest rates. Debt issuance is supposed to be suffocating right now. So is this core business actually growing, or are they just using paper manipulation to mask some really dangerous structural risks hiding in the background?
See, that is exactly why we never, ever just take the reported numbers at face value. Let's look at the raw materials here. On a reported GAAP basis, S&P Global printed revenue of $4.146 billion. Now that's up 10% year over year, alongside a GAAP EPS of $4.08, which itself is up 26%. Sounds great, right? But to answer your question, we have to look at the cleaner pro forma results. We need to exclude the mobility spinoff and all that associated transaction noise to see the real picture. When you strip all that away, the pro forma revenue of the remaining core was $3.678 billion. And here is the absolute kicker. That represents an 11% year-over-year organic constant currency growth rate. Think about that. The core is actually growing faster without mobility attached to it. And it doesn't stop there. Pro forma adjusted EPS surged 23% to $4.83. So to your point, no, this isn't just paper engineering. The fundamental cash-generating machinery is legitimately operating at a noticeably higher capacity. Just look at this. Notice how removing the lower margin drag of that mobility business causes the pro forma operating margin to jump an incredible 410 basis points, landing at 47.8%. And if we isolate the adjusted operating margin, it hit a staggering 54.3%, which is up 200 basis points. That's a massive profitability engine.
Okay, fair enough. An adjusted operating margin over 54% is undeniably a cast iron metric. That's huge. But you know as well as I do that margin expansion can easily happen through aggressive short-term cost-cutting right ahead of a spin-off to make the books look pretty. I need to know if the individual business segments are actually pulling their own weight here, or if they are just leaning on past momentum and cutting corners.
Section 2, stress testing core pillars. Time to see what's actually holding the roof up.
We absolutely need to apply immense pressure to each segment to see which ones are carrying the heaviest load and to see if any are showing early signs of metal fatigue.
Right, and I'm looking at this revenue breakdown, and honestly, I see heavy concentration. How durable are these pillars, really? You have massive macroeconomic headwinds blowing incredibly hard against them right now across the globe.
Well, let's break down the exact revenue weight distribution for Q2 2026, and you can decide. The ratings division is by far the heaviest lifter, pulling in $1.339 billion. Next up is market intelligence at $1.235 billion on an adjusted basis. Then we have energy, which is essentially their commodity insights business, holding up $623 million. And finally, the indices pillar, bringing in $534 million. Those four segments right there, they are the bedrock. But the real story, the thing you have to pay attention to, is what's happening inside that ratings pillar.
This number right here, 25%. This is the single most important metric in the entire earnings release. We saw a massive 25% surge in ratings transaction revenue, and that was driven specifically by a massive spike in investment-grade bond issuance. Wait, hold on. Time out. That literally doesn't make any sense. The entire market has been absolutely terrified of higher-for-longer interest rates. Corporate borrowing costs are elevated across the board. Why on earth is issuance surging 25% in this kind of environment? That shouldn't be happening. Because you are totally underestimating the sheer industrial force of the AI revolution and corporate restructuring right now. Companies are rushing to the debt markets. Why? Because they have to finance massive artificial intelligence infrastructure projects. We're talking liquid cooling systems, entirely upgraded power grids, data centers. M&A activity is also waking up fast. These corporations need colossal amounts of capital to build out this infrastructure. And guess what? They need S&P ratings to price that debt before they can lay a single brick. So this pillar isn't just surviving higher rates, it is completely thriving because the desperation and demand to build the future is completely overriding the elevated cost of capital.
And the structural strength doesn't stop there at all. Let's examine the indices pillar. It generated $534 million, accelerating at 20% year over year. I want to aggressively highlight a 22% jump in asset-linked fees.
Sure, but asset-linked fees are great when the market goes up, right? But that inherently exposes them to massive equity drawdowns. If the market tanks, those fees tank. That's a major structural vulnerability in that pillar, isn't it?
It would be, absolutely, if the base wasn't so impossibly wide. S&P Dow Jones Indices reported that their ETF assets under management exploded to $6.35 trillion. That is up 34% year over year. Furthermore, they just hit a massive historical milestone. A single ETF tracking the S&P 500 reached $1 trillion in AUM for the very first time in history. Just one fund. Plus, you mentioned drawdowns. Well, with market volatility come hedging, which actually drove a 22% increase in exchange-traded derivatives revenue. This pillar is practically bulletproof. It makes money in surging bull markets, and it makes money in volatile, choppy markets.
Okay, fine. Ratings and indices are tied to market action. But what about the recurring subscription-based revenue? I'm trying to probe for weaknesses in the sticky money here. Are enterprises quietly cutting their data budgets behind the scenes to save cash?
Let's inspect those recurring revenue beams then. Market intelligence grew 6% year over year to $1.235 billion on an adjusted basis. Energy grew 3% to $623 million. Now, are these explosive growth numbers? No, they aren't, but they are incredibly stable. Management is currently restructuring the leadership over in market intelligence to integrate Kensho data and platforms much more tightly. They are shifting away from just piecemeal data sales to a comprehensive enterprise solutions model. And over in the energy sector, the Platts benchmark remains the absolute gold standard for the industry. It's providing insane stability despite all the extreme macroeconomic and geopolitical headwinds hitting the global commodities space right now.
Section 3. Heavy lifting, capital and cash. Look, a company can have a great foundation and incredibly sturdy pillars, but if it doesn't generate massive liquid cash to actually return to the owners, it's just a glorified museum. We need to inspect the mechanics of how S&P Global generates real cash.
Well, before we get to the cash mechanics, I have to throw a wrench in the gears here. Every single CEO on Wall Street is talking about artificial intelligence right now. It is the ultimate corporate buzzword. But is S&P Global's AI narrative just corporate spin to keep their stock multiple inflated? Or are they actually monetizing this tech? Because if it's not driving enterprise adoption and real tangible cash flow, then it's just really expensive R&D that's eating into profits.
It is absolutely driving real cash flow, and honestly, the numbers are industrial grade. In Q2 alone, they generated $1.330 billion in free cash flow and $1.370 billion in adjusted free cash flow. This cash is directly tied to their technological execution. They aren't just buying chips and throwing out buzzwords. They are successfully monetizing AI through deep enterprise adoption of Kensho APIs and Capital IQ Pro. Think about what they're doing. They are taking massive, unstructured datasets, stuff like global supply chain logistics, private market financials, complex geopolitical risk metrics, and using their proprietary language models to let clients query it instantly. That literally cuts days of analytical grunt work down to seconds. So now, it's not hype, it's a fundamental, heavily monetized upgrade to their recurring subscription pipelines.
And here is the visceral punch for anyone still doubting the cash-generating power of this new four-pillar structure. S&P Global has already executed $1.5 billion in share repurchases year to date.
But management just committed to a massive acceleration of that program. They're now targeting over $7.0 billion in total share repurchases for the full year 2026.
$7 billion? Seriously? That is a staggering amount of capital to return in a single year.
Exactly. It completely reinforces that cast iron foundation we've been talking about. Look, you don't authorize a $7 billion buyback unless your internal visibility into your future cash flows is crystal clear. They are aggressively eating their own shares, essentially increasing your ownership stake in this massive toll bridge for free.
Section 4. Blueprint 2026 Guidance Realignment. Let's look ahead.
So we've analyzed the past quarter, but as we know, the market is a forward discounting mechanism. We have to look forward. Let's examine how management is realigning their expectations and guidance for the remainder of 2026 now that the mobility division has been successfully detached and spun off.
All right, well, this is exactly where I usually find cracks in the armor. Companies love to spin off divisions and then quietly lower their forward expectations, usually blaming some sort of unexpected transition costs. So tell me, is management overpromising on what these 4 remaining pillars can actually deliver in what's going to be a very volatile back half of the year? We still have elections, geopolitical tension, and massive rate uncertainty to get through.
I hear you, but there are absolutely no cracks in this forward guidance. S&P Global pointed right to the realigned numbers and firmly reaffirmed their non-GAAP adjusted diluted EPS guidance of $17.50 to $17.75 for the full year. They are not hiding behind transition costs at all. Furthermore, they are projecting a robust full-year organic constant currency revenue growth of 6.0% to 8.0%. This proves the blueprint is rock solid, even against a backdrop of serious macroeconomic anxiety. They fully expect to expand operating margins aggressively and drive high single-digit organic growth. The structural integrity holds up entirely under the forward projections. Section 5. The verdict. Ironclad or TRAF. Let's bring it all together. We've run all the diagnostics. We've stress-tested the margins, the pillars, the capital return, and the forward blueprint. So the crucial point we have to settle on is this. We are looking at a fundamentally transformed company. By shedding mobility, S&P Global has revealed a highly efficient, high-margin, 4-pillar financial intelligence powerhouse. Ratings are surging on AI infrastructure financing. Indices are hitting historic trillions in AUM. They are generating immense free cash flow and literally incinerating their own share count with a $7 billion buyback. To me, this is the very definition of a cast iron moat.
Okay, I'll admit that 54.3% adjusted operating margin is incredibly difficult to argue with. It just is. And the 25% surge in transaction revenue completely defies all the higher for longer interest rate fears I had coming into this. However, as the voice of the retail investor here, I have to point out that if we do hit a sudden severe macroeconomic recession that halts debt issuance and tanks equities simultaneously, ratings and indices will absolutely take a structural hit. It's an undeniable premium company, but you're absolutely paying a massive premium valuation for this quality.
That's fair. Quality always demands a premium. But as we've seen today, S&P Global has the pricing power and the structural leverage to defend that premium against almost any market condition thrown at it. That concludes our structural stress test of S&P Global's Q2 2026 earnings. Remember, to survive in these markets, you can't rely on financial spin from the talking heads. You have to inspect the foundation yourself. But as this AI revolution accelerates and global debt continues to pile up, we really have to leave you with one final question to ask yourselves. Is S&P Global simply rating the future of finance, or are they the ones quietly controlling it? Keep stressing the numbers, and we'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.